the sum and substance and the substratum of underreported income is that all additions, disalliances, adjustments which are made under section 92C. I'm not talking of adjustments under section 143(1)(a). So additions, disalliances, adjustments made under section 92C put together, that kitty will be called underreported income. This is now, if there is underreported income, this is that underreported income with reference to which the direction can be given by those authorities to impose penalty. But prior to that, there is subsection 6, which says that the incidence of the underreported income, the impact of the underreported income now can be reduced. It can be reduced by the assessing officer. It can be reduced on the basis of the pleadings and evidences filed or to be filed by the assessee. Though assessment, for that matter, the penalty proceedings are the quasi-judicial proceedings. The assessing officers are supposed to have judicious, objective, fair, rational, conscientious approach towards the assessment and penalty. But we have got all sorts of assessing officers. Hyderabad may not be an exception to it. But then now we have got invisible assessing officers after the advent of the electronic assessments. So the impact of this underreported income can be reduced by taking advantages of the exhaustive 5 situations which are given under subsection 6. Therefore, it is necessary for us to appreciate as to what are those clauses. The first clause is that if the amount of addition or the disalliance, because after all, underreported income is nothing but the sum total of all additions and disalliances. So whatever additions and disalliances out of this bag, we are able to take them out, then our underreported income's baggage would be less heavier. So the first addition, the first clause of subsection 6 of section 270 capital A is on this line, that if an addition or disalliance made by the assessing officer, which is part of the underreported income, and the assessee explain before the concerned assessing officer, commissioner of appeal, or principal commissioner. So I will not be naming all the 3 authorities. So if in respect of any addition or the disalliance made in the assessment, if an assessee offers an explanation which is substantiated by him, and that explanation is found bona fide by the officer, and assessee discloses all material facts and substantiates the explanation. So if in respect of any addition or disalliance made in the assessment order, if you either during the course of assessment or even during the course of penalty proceedings, because assessment and penalty proceedings are 2 separate, independent, distinct proceedings. Certain pleadings on facts, certain evidences on facts, you may not have argued it during the assessment, but you can very well raise them without incurring the disability of the so-called additional evidences having been brought against you in the penalty proceedings. So you can even explain during the penalty proceedings with the help of the fresh pleading, with the help of the fresh evidences, that, sir, here is my explanation in respect to that addition. That explanation is bona fide. There is no mala fide. I have disclosed all material facts in relation to these explanations, and I have substantiated also. Now, this is the first exhaustive clause of subsection 6 of section 270 capital A. You would kindly recall that in section 270(1)(1)(c), there used to be explanation 1. That was a rule of evidence. And explanation 1 capital B was also almost on these lines, that in respect of any facts material to the computation in respect of an assessee for a year, if you have disclosed the facts, if you have not disclosed, or you have disclosed the facts which you have not been able to substantiate, and all material facts you could not be able then such person offers an explanation which is not able to substantiate and fails to prove that such explanation is bona fide, that all the facts relating to such material to the computation has been disclosed by him, then in that situation the amount of addition or the disallowance would be deemed to represent income in respect of which the particulars of income were concealed. So now instead of negatively worded, here subsection 6 words this as, and not by way of an explanation, as one of the clauses of subsection 6, that to in a positive frame. So whenever any addition is made which is part of the underreported income, obviously, then in that situation you must bring out your case within this exception, that you have offered an explanation which is bona fide, you have disclosed all material facts, then you have substantiated. If you are able to cross these 4 hurdles, then that amount of addition or disallowances will be reduced from the total amount of underreported income. And in case the assessing officer, by taking a quasi judicial view, does not agree with you, then that is not the end of the road. Then you have got right to get his decision reviewed before the appellate authority. Anyway, now the second clause under subsection 6 is that when the amount of addition or disallowance which has been made by the assessing officer on estimate, despite the books of accounts having been found correct and complete, on this ground that addition was made on estimate, that the method employed is not such that would yield the deduction of the correct total income. Though, I mean, on the face of it, looks very that books of accounts were found correct and complete, but the method is such that the correct profits cannot be deduced, and you have disclosed all material facts. Then in that situation, that amount of addition or the disallowance made by the assessing officer on estimate, now that will be taken out or reduced from the amount of the underreported income. Suppose you have maintained complete books of account which found approval from the assessing officer, but then the method of valuation of closing stock is such which in the opinion of the assessing officer would not give the correct profits under that business, and therefore he makes additions based on estimate. But then if addition is not based on estimate, then you would not fall under this clause. Then you will have to make out your case under clause A, that your explanation which is bona fide, disclose material facts and substantiate. Suppose you are a real estate developer maintaining very comprehensive books of account. You are required to have followed PCM. You have gone in for CCM, completed contract method, and because of this discrepancy which was found in the method of accounting being followed by you in respect of the contracts income, now assessing officer assumes jurisdiction to make additions based on estimate. And you have disclosed all material facts. There is no allegation against you in the assessment order that you have withheld the material facts. Now in that situation, you would fall under this exception. You can plead before the assessing officer, sir, I fall under this clause, kindly exclude my income from the underreported income. Kindly lighten the weight of the underreported income back. The third is when the addition or the disallowance made by the assessing officer is on estimate, by enhancing the estimate, because originally you also made some estimate, provided you have disclosed on material facts. So when you yourself made some estimate in your return of income, the assessing officer finds that estimate on the lower side, and therefore he enhances that estimate versus estimate, the words against words, provided you have disclosed material fact, then you would fall under this exception under clause C. So make out the case, sir, I myself showed this much of disallowance in my return of income. Now assessing officer has merely enhanced it. Books of accounts were produced and I have disclosed all the facts material to that addition. Then you will be entitled to get this amount of addition excluded from the purview of underreported income. The estimated disallowances we see day in and day out in the assessments which used to be made. The fourth is that when the additions or the disallowance made is in respect of the transfer pricing adjustment based upon the order of the transfer pricing officer, now would not form part of the underreported income if you have disclosed the transaction, you have maintained the records which are required to be maintained under section 92D, that is the transfer pricing documents, and you have disclosed all the facts material to the addition. This facts material to the addition is something which is very dear to the framers of law. So if addition or the disalliance made is represented by the transfer pricing adjustments, provided you have disclosed material facts, you have disclosed transactions, and then you have maintained records under section 92D. If you remember, under explanation, under section 271(1)(c), there used to be an explanation 7. And there was a presumption that you have furnished accurate particulars of income the moment such adjustment used to be made, unless you would have proved otherwise. That I mean all those ingredients which according to me as compared to this clause were somewhat onerous, somewhat more onerous. So whenever the legislature shows magnanimity, even maybe in a very small measure, as I said in the beginning, that whenever somebody speaks good for you, you are bound to receive it with full hand. So whenever any amount of magnanimity, howsoever small, remote, indirect, that magnanimity may be coming from the legislature, accept it. So to that extent, I would say that the rigor of that explanation under the old section 271(1)(c) has been diluted. Fair. And the next exclusion is that in case of searched person, there are specified previous years, as you know, and a specified previous year is the year in which the search has taken place, or a year immediately preceding to the year of search, where the due date of filing of return has not come, you have not filed the return. Then in that situation, these will be two specified previous years. And in respect of these specified previous years, kindly mind it, if in respect of these two specified previous years, there are undisclosed income, and undisclosed income has come to be defined under the explanation to section 271(a)(b), based upon the cash, money, bullion, jewelry, valuable article or thing, or any entry in the books of account which is found to be false. So these are the undisclosed income as a result of search. So qua such undisclosed income in relation to these two specified previous years, such undisclosed income would be taken out from this kitty of underreported income, because this penalty or this underreported income or undisclosed income for the specified previous year is liable to be penalized under section 271(a)(b). That is why it is not as if the legislature is showing again any magnanimity, because legislature cannot punish a person twice for one and the same default, and therefore I mean this is an exclusion from that point of view. But then in respect of even those specified previous years, if there are additions and disalliances which are made in the ordinary course of assessment, of course based upon the return of income which you have filed, then those additions would not constitute undisclosed income under section 271(a)(b), and therefore qua such additions and disalliances, penalty under section 270(A) may be levied, because these additions and disalliances, other than the additions, disalliances in respect of undisclosed income, even in the specified previous years, would constitute part of underreported income. But then our assessing officers are ignorant. Their ignorance is the bliss. They probably think that in these specified previous years, penalty which can be initiated is under section 271(a). So if they are ignorant, being ignorant sometimes is good. Be ignorant, and that is better if that ignorance is on the part of the other side. So with the help of these 5 exclusions and exceptions, if you are able to lighten the weight of the bag of the underreported income, and then whatever balance is there and whatever balance remains out of that underreported income, Suppose if the additions, total additions which were made were to the extent of 50 lakhs of rupees under 5 heads. Let us assume in respect of 3 additions, say for 30 lakhs, you had been able to get them out from the definition of underreported income. So now the net underreported income, though the word net has not been used in the act, but then for the sake of comprehension, I am using this word. So the net underreported income becomes 20 lakhs. Now on this 20 lakhs, if this underreported income remains underreported income simpliciter, why I am saying simpliciter? I will come, because the department's attempt would always be to make this underreported income to be not the underreported income simpliciter, but to make this underreported income as if this underreported income is in consequence to misreporting of. I'll come to that aspect little later. But under subsection so if there is underreported income simpliciter, then you compute tax. 50% of the tax payable as underreported income is payable as per subsection 6 or 7. So subsection 7 of section 270 capital A. But then comes subsection 8, which says that if this underreported income is in consequence to misreporting of income, then the revenue would not be satisfied with 50% of the tax payable, but we would charge you 200% of the tax payable. Like if you remember under section 270(11)(c), the penalty could be imposed from 100% to 300% of the tax sought to be evaded. The expressions there were tax sought to be evaded, whereas now the tax payable. Now there must be tax payable, because in section 270(11)(c), if I say something which may appear to be very absurd, is that there could well be a situation in section 270(11)(c) that even if you have disclosed income, even if you have disclosed that income in your return, you paid taxes, but when the assessing officer asked, "Oh, gentleman assessee, you have paid taxes, is good, but you now kindly let me know as to what are the particulars of this income, because I want to trace the source of this income." Assessing officer withholds the particulars of income. Assessee says, "I have bared my chest by disclosing this income in the return. I have paid the taxes. You must be concerned with the fruits, not with the trees. And therefore, I do not want to part with the particulars of it." Or alternatively, he furnishes some particulars, but those particulars are inaccurate particulars. So even in such a situation, in section 271(1)(c), read with explanation 4, there could be an occasion, though I know Chandigarh bench, where my wife is a member income tax appellate tribunal. Now, Chandigarh bench has given this decision that when there is no tax, ostensible tax, that there cannot be a penalty 271(1)(c). With utmost respect, I beg to differ with that decision. There could be a situation in the example given by me. If we read carefully explanation 4 to section 271(1)(c), there could be the levy of penalty, because under section 271(1)(c), as I said in the beginning, was not on concealment of income, it was on the concealment of the particulars of it. It was not on concealment of income, it was on the aspect of the furnishing inaccurate particulars of it. That is why the legislature in 2016 brought section 270 capital A, irrespective of the particulars, you declare the amount in your return of income in 2016 when this section 270 capital was brought. I am not talking of Taxation Law Second Amendment Act, which was brought in December 2016. So, and initially the thought process of the legislature appeared to be that whosoever makes declaration in the return of income, we are not concerned with particulars. If he pays tax, no penalty can be levied, because penalty cannot be levied because there would not be any difference between the assessed income and the return or the returned income or the processed income. This legislature mind changed when, after demonetization, when this kind of opinion was coming from all quarters, that let everybody declare those currency amounts as the income, in the return of income and pay 30% tax, there will not be any penalty. Under section 270 capital A, penalty could not have been there as per the then prevailing law, because the income assessed and income assessed and income returned or income processed, there would not have been difference. Then the legislature became wiser. They brought section 115 BBE, which built this element of penalty into the tax itself, and that too was made effective retroactively. It was made effective from assessment in 1718. This amendment was brought on 15th of December 2016. Therefore, income earned from 1st April 2016 to 15th of February 2016 also is bound to suffer the tax rate of 60% and not 60. 15% surcharge, 3% cess, 78%. Anyway, so I am on this point. 200. So in 271(1)(c) there used to be 100% to 300% depending upon the facts of each case. The assessing officer judicial discretion vested in him, that in appropriate case he could have imposed penalty more than bare minimum of 100%. 100% was if there was concealment of particulars or furnishing inaccurate particulars of income. When it comes to the quantification of penalty, minimum 100% penalty was there, but then it could have gone up to 3 times 100% depending upon the severity of the or habitual default on so many factors. But here, if there is underreported income in consequence to misreporting of income, then the penalty is 200% of the tax payable. So what is misreporting of income? It becomes very essential for us to know, and there are several interesting situations which I would come, and then thereafter I will rake up the issues. I think I have got 2 hours time. Then I have got 271 AAD also, and we will.
Yes, sir. Please take your time. Only thing is you are looking a bit uncomfortable, and I'm worried about it.
No, I am not uncomfortable.
So
I may appear to be quite, stocky and bulky, but you would be surprised to know I play at least 6 games of badminton every day.
I'm fine, sir. We'll be glad, but only thing is please take care, because you can just continue to have some warm water or something.
Well, no, it is here. I am drinking simultaneously.
Pankaj bhai, if Dr. Gupta would have been a cricketer, probably he would have opened the inning and we would not have allowed anybody else. He can do the entire match alone. Don't worry about that.
Thank you, sir. Thank you.
Yes. So I was on misreporting of income. Now this misreporting instances have been given exhaustively under subsection 9, clause A to F. And A to F, this misreporting, it starts with the first clause, misrepresentation or suppression of facts. Now you kindly see the legislature has tried to become very smart. I will come to that aspect little later, because the way the section 270 capital has come to be drafted, the legislature tried to ensure that all those hyper technical arguments which used to be taken by the SSC, the various stages of the appellate mechanism, they cannot be taken. But I will show that the legislature has scored the self goal. But before I come to that, section 270 capital A subsection 9 says that underreported income in consequence to misreporting of income would be there if these are 6 instances which are there. They can be there either singly or in combination of any other. But even if one or more clauses are applicable, still it will be called underreported income. The legislature tried to play very smart, because if you remember in 271(1)(c), there used to be contest, there used to be jhagda, whether it is for concealment of particulars of income or whether it is for furnishing inaccurate particulars of income. I must tell you, my young partner C.A. Saumil Agrawal, who also must be watching it, he has helped me in such a big way to do postmortem of section 270 capital and 271 AAD. I will be failing in my duty if I do not extend my compliments to him. All these nitty-gritties, nuances which I am speaking with you is because of his effort. Anyway, so legislature has sought to ensure so that it may not be in a position, or it may not be in a position to face such kind of situations whereby the SSEs argue that, sir, assessing officer has not said misreporting, assessing officer has not said underreporting. So the legislature has said that even if the addition is on account of misreporting of income, but at the end of the day, it will be called as underreported income, maybe in consequence to misreporting of income, so that those arguments that the charge was not specific, I mean, that can be defeated. But whether legislature had been successful in defeating, we will come to that aspect little later when we will discuss about the issues. So I am on these 6 issues, A, B, C, D, E. Now, misrepresentation or suppression of facts. Now, whether we are away from the old expressions of concealment of particulars of income or furnishing inaccurate particulars of income. What is misrepresentation of facts? That it is somewhat identical and akin to furnishing inaccurate particulars, that you have misrepresented, you have furnished inaccurate particulars of income. We are back to the square one that I will show. It says suppression of facts, you are withholding the particulars. So whether the difference in the terminology as compared to the terminologies used in section 270(11)(c), whether would have made any difference at all. Misrepresentation or suppression of facts. Now all these clauses are overlapping. There can be suppression, that suppression may be because of misrepresentation. So this clause, misrepresentation or suppression of facts, itself would have been enough. But legislature has tried to be very cautious. I always say that the legislature has got its own ways, or government for that matter, has got its own ways of functioning. I remember one of you, my very good friend from your place, from Visakhapatnam, Mr. J. Sudhakar Reddy, who is accountant member. Now he once told me, Rakesh, how does the government function? The government, he said very nicely, he aptly put it, that government is like a bulldozer. Now before the bulldozer moves very slowly, you keep on dancing before it, it will not harm you, it will not catch you. But once it catches you, and government is like a bulldozer, but once it catches you, then it will not spare you. Because the government also is known for making knee-jerk reaction, and that is why the government said, instead of concealment or furnishing inaccurate, instead of misrepresentation or suppression, let us add few more clauses so as not to leave any scope for any seepage or leakage. Otherwise, all these instances of B to E, B to F, I would show, all are covered either in misrepresentation of facts or under suppression of facts. But one thing which has to be borne in mind, that all these 6 clauses must lead to the addition or the disalliance. Because if the addition or disalliance is not there, maybe I may have misrepresented something in a very big way. But because of my misrepresentation, or because of my suppression, or because of my recording false entry in the books of account, if there is no difference resulting between the assessed income and the returned income, then I may be hauled up for that misrepresentation somewhere else. But there will not be any penalty under section 270 capital A. Because after all, underreported income is the difference between the income assessed and the income processed. So if there is no income resulting as a result of even my misreporting, then it will not, the charge would fail. It will not turn into the penalty, because there will not be underreported income. There will not be underreported income, there will not be any tax payable. If there is no tax payable, I mean, where is the question of penalty? Now, suppose one example I give you, in case of a closely held company having sufficient amount of accumulated reserves, gave loan to one of the shareholders who was having more than 10% shareholding in that company. Obviously, section 2, subsection 22 clause E is there, which says that to the extent any distribution by way of loan or advance to a shareholder holding more than 10% shareholding by a closely held company to the extent of accumulated profit will constitute deemed dividend. Now, this company SSE, in order to give a camouflaged shape of this transaction so as to avoid this transaction from the glare of section 222E, now shows it as if it is a loan or advance. Assessing officer during the course of assessment catches hold of it and says, oh, it is the deemed dividend. But then the dividend has to be taxed in the hands of the shareholder, not in the hands of the company. Now, can there be a better case of rank misrepresentation or suppression of facts than this? Because the assessing officer caught with the help of some, let us assume, on the basis of some hardcore evidences, that it was a loan solicited to that shareholder. It was not a business transaction. That business transaction was sought, this transaction was sought to be put in the guise of business transaction, so as to take advantage of all those judicial decisions that this is not loan, this was during the course of carrying on normal business. So what I am underlying, and I'll keep on underlining this, that even if I may have misreported my income because of either under A, B, C, D, E, F or subsection 9, it must result into income. Only then penalty under section 270 capital A can be levied. Now, clause B, failure to record investment in the books of account. Now, it has become a dead letter insofar as section 270 capital A is concerned. If there is a failure to record investment, then the addition, though, would be made under section 69, but then the tax rate will be the special tax rate under section 115 BBE, because this Finance Act, by which section 270 capital A was brought, was passed somewhere in April or May. At that time, the legislature had got no inclination that some situations will develop like this, that they will have to consent to make section 115 BBE, which will cover such kind of situations. 115 BBE, though was there in the statute, but the tax rate was enhanced by the Taxation Law Second Amendment Act from 15th of December, effective from assessment in 2017-18. And when that tax rate is applied, then section 271 AAC was also enacted. So in that situation, the penalty which is leviable in respect of such unrecorded investment, the additions of which will be made under section 69, will be made under section 69, under section 115 BBE, the tax rate penalty would be under 271 AAC. So failure to record investment in the books of account may be a valid clause when section 270 capital A was introduced to begin with, but then it has become a dead letter after the introduction of the Taxation Law Second Amendment Act 2016. But then one question which comes to my mind, when you have tried to make these clauses so exhaustively, so as not to leave any scope for any taxpayer not to be covered in case the facts are obtaining on these lines in his case, then what prevented from you at that time in April 2016, when you enacted it, when you could enact a failure to record investment in books of account as one of the instances, then failure to record expenditure, why was not? I'm on the parity aspect only, because even failure to record an expenditure of the books would have been there, that also would have become a dead letter in the light of the Taxation Law Second Amendment, because in that case the additions could be made under section 69C, enhanced tax rate 115 BBE, the new penalty provision 271 AAC would have been attractive. But I'm on this point that when the legislature, despite being so cautious, happens to commit errors like this. The next is claim of expenditure not substantiated by any evidence. And you see, this non-substantiation may be because of suppression. I mean, the evidence has been withheld, and because of that withholding the evidence, the substantiation could not be done. What I am emphasizing, that all these clauses are overlapping. A default of an SSE may fall under more than one sub clauses of section 9, and kindly see the beauty which the legislature has tried to make, even at the cost of repetition, I would say. But at the end of the day, additions, disalliances made would be called underreported income, so that no SSE can take advantage of that kind of a situation that the charge is fluid, the charge is vague, it is not specific. That is how the legislature has tried to play smart. So expenditure not substantiated by evidence, I would read it, if this non-substantiated expenditure goes to increase the total income. Suppose if I am a 100% exempt unit, though there are not many, but then still there are certain sections under the Income Tax Act, the whole of the income either can be claimed as a deduction under section 100, can be claimed as a deduction under chapter 6A, or for that matter under section 10AA. So if any expenditure in respect of carrying on those businesses remains unsubstantiated, and because of such expense remaining unsubstantiated, the addition is made, it is not going to make any impact, because ultimately it will be subsumed in the 100% deduction. And even if I may not have been able to substantiate the expenditure in such circumstances, there will not be any penalty under section 270 capital A, because there was no difference between the, and had such kind of situation been there under section 271(1)(c), it would have invited the penalty decisively, because you have not only concealed the income, you have concealed even the particulars of income. Here you are concealing the income, but because you are concealing the income, you are concealing the particulars of income, the correct particulars of income in subsection 9. But there is no tax resulting out of it. There is no underreported out, because this entire, because it will swell your business profits. There may be n number of instances I can give, but then I am conscious about the time limitation. Let us, recording of any false entry in the books of account, the for which you have made 271 AD by the Finance Act 2020. But at that time you could not have anticipated, therefore you thought that we will punish it here. But then with the advent of section 271 AD, the rigor of this clause would not wither away, would not disappear. It would also keep on staring at the face of the taxpayer. Recording of any false entry in books of account, provided it results into income. Suppose if I had taken bogus bills, showed it as my income, credit to my profit and loss account. Rather, I am showing it as my income. So in such a situation, there may not result into addition. So if it is not resulting into any addition, thereby there is no computation under reported income, then there is no penalty. So despite I recording false entry in the books of account, in certain situations, my total income is not enlarged, and though I have misreported, but then there will not be an impact of penalty. But then if it is resulting into an addition or disalliance, then obviously there would be penalty. Then failure to record of any receipt. Now kindly see the legislature's inconsistent behavior. Failure to record any receipt in books of account having a bearing on total income. Now this phrase having a bearing on total income, in fact, ought to have been there with all the clauses. I am at loss to understand as to what has impelled the legislature to suffix these expressions only against this clause. So failure to record any receipt in the books of account, that may be because of the reason, probably it appears to me, that there may be some capital receipt which may not have been recorded in the books of account, but then when the assessing officer went deeper into it, then it was exposed, oh, it has got the bearing on the total income, it is liable to be added to your income. So then next is failure to record and failure to report any international transaction or a specified domestic transaction. So if you have disclosed these transactions, then you could have taken out that adjustments out from the definition under reported income under subsection 6 clause D. But then if you have failed altogether in reporting the international transaction, then in that situation, but then as I said, it must result into, suppose you have withheld certain international transaction. Suppose you have paid royalty, you have not reported it. Now, because of non-reporting, there may be other consequences in the form of levying penalty and all. That will follow. But we are on the penalty 270. Now, assessing officer or the transfer pricing officer, when they discovered, oh, here is the international transaction which you withheld, then they would ask the details, you substantiate, you prove that this transaction, though I withheld it, but then it is at arm's length and therefore does not call for any additions or adjustment. So, despite I withholding international transaction, but I am not withholding any income resulting from this transaction, it will be of no consequence insofar as the penalty under section 270 capital A is concerned. But of course, burden to prove the case of the SSE in respect of misreporting would be on the shoulders of the assessing officer. If you remember, we have got explanation 1 capital A, where in respect of the facts material to the computation of an SSE in respect of a previous year, no explanation is offered, or explanation offered by an SSE is found to be false. There also, the burden to prove that explanation of the SSE is false used to be on the shoulders of the assessing officer. Here also, it will be for the assessing officer to prove and establish that, sir, here is the misreported income, or here is the underreported income. Here are the additions, here are the disalliances, and because of the addition disalliances, these are the underreported income, and these are not these are underreported income, not underreported income simpliciter, but these are underreported income in consequence to misreporting of income. Now, I'll take certain issues. The first issue which I want to take is whether initiation in the assessment order and recording of satisfaction is still needed or not, despite the revenue would say, what the department would say, because as a devil's advocate, you'll have to take care of what kind of an argument will come from the other side. I remember in Hyderabad when I was sitting on the bench, Mr. A. Satyanarayana, who used to be the vice president once upon a time in the tribunal and who was practicing. I do not know how is he keeping his health nowadays. Now he was arguing on matter. Many of you may recall he had written one book on capital gains. His junior, Mr. C.N. Prasad, now is in the bench in Mumbai benches tribunal. He became member along with Ashwini ji. So Mr. Satyanarayan, Mr. C.N. Prasad Rao, Mr. C.N. Prasad, they used to come together. So Mr. Satyanarayan had written some book on capital gains. One day he was arguing one proposition which was contrary to what he wrote in his book. And I remember Mr. C.P. Ramaswamy, who was representing the revenue, he started his argument that advocate Satyanarayana sir is arguing against the author Satyanarayana. So 271(1)(c), this is the devil's advocate. The department would say, sir, we have made the language of section 270 capital A, which is divorce of any satisfaction, unlike section 271(1)(c), because section 271(1)(c) used to say when these authorities during the course of any proceeding is satisfied, therefore we have done away with satisfaction. So we do not require the satisfaction of our officers anymore. We want them merely to direct that this person shall pay penalty in respect of underreported income. So when the language has been changed as compared to section 270(1)(c) and the word satisfaction has been consigned into the Arabian Ocean, then wherefrom you are deciphering that satisfaction is still required. The department would say that all that is required now for these authorities to give direction, and the direction can be in the penalty order. So when the direction to pay penalty can be in the penalty order and section 270 and subsection 1 require such authorities to give directions, that should be the end of the matter. So the revenue would say, sir, in the light of such clear-cut expressions used in section 270A1, I mean, there is no need for the satisfaction. Then the revenue would say, sir, penalties on underreported income. And in underreported income, you have not to do any, what should I say, any scientific working. The moment there is a difference between the income assessed and income processed, underreported income would automatically result. And when something which is automatically to result, now where is the question of recording satisfaction or no? Department would say. And fourth thing, the department would say, sir, under section 271, under section 271, there used to be a very important subsection which most of us may have skipped it, and that was subsection 1 capital A, and that used to say of initiation of penalty in respect of the intangible additions made in the earlier years, in respect of which the penalty was not imposed. So whenever we wanted to say that the penalty has to be initiated in the course of assessment proceeding, now in 270 capital A, there is no such corresponding provisions having been made. Therefore, we are very much clear. We do not want any initiation. We do not want any recording of satisfaction, which used to be there under section 271(1)(c), and for which there was much hullabaloo having been made in all these years by the astute chartered accountants and lawyers, and because of which, even in the most legitimate cases where the penalties ought to have sustained, I mean, they have fallen. But then what the SSEs would say. In fact, this article, I do not know, our written article by me and Somil, my partner, young, he's a chartered accountant, company secretary, cost accountant, DISA, LLM from UK, young boy. Now he brought out, I mean, such instances out of section 270 capital A to say, sir, because of these reasons, the assessing officer is still required to initiate penalty in the course of the assessment proceeding, and it must be evident from the bare reading the assessment order. So he says, sir, first of all, in this article, I would request Somil, because he must be listening, that we must send it to Mr. Pankaj Trivedi so that it can be circulated. Though it has been published in either Taxman or Tax Sutra or somewhere, I do not remember, but it can be circulated amongst the members. So the first thing which we would say in favor that still the initiation recording of satisfaction is must, because after all the penalties are underreported income, underreported in consequence to misreporting of income. Nonetheless, whether it is underreported or misreported, but at the end of the day, it is income. Income is computed in the assessment order. And therefore, something which is computed in the assessment order with reference to which the penalty has come to be imposed, therefore, there must be initiation in the assessment order. The second situation, subsection 3 of section 270 capital A, which defines the preceding order, because section 270 subsection 3 says that how the underreported income would be computed. And the measure is that in case you have previously been assessed, then subsequently, if any order is passed, the difference between the income assessed in that order and the income assessed in the preceding order. So the preceding order has come to be defined, and that says that preceding order means the assessment order during the course of which penalty under section 270A subsection 1 has been initiated. So even the section 3 clause 2 of section 270 capital A itself says, explanation A, read with explanation small a to section 270A subsection 3 says that which assessment order during the course of which penalty under section 270A1 is initiated. This is first instance of self-goal. The second instance of self-goal is section 270 capital A, which grants immunity. Now subsection 3 of section 270 triple A, 270 double A, 270 double capital A subsection 3 says that where the proceeding for penalty under section 270A has not been initiated under the circumstances referred to in subsection 9 of section 2. So even this section is also contemplating, visualizing, envisaging of initiation of the penalty, because how can an SSE come to know when he wants to go in for claiming immunity, and that immunity has to be claimed within a period of 30 days from the end of the month in which he has received the assessment order. At that stage, how would he know that whether the penalty which has been initiated is as a result of misreporting or for underreporting simplicity? So this is giving a special point to say and show that the penalty. Then section 275, which prescribes the limitation period of the penalty. Now it says one of the limb is financial year in which the proceedings in the course of which action for imposition of penalty has been. Now this has not been changed. So 275, which is the law of limitations in respect of the penalty, is concerned. Now it is saying that during the course of which action for imposition of penalty has been initiated or completed. So penalty proceeding has to be initiated during the course of proceedings. Then when the commissioner appeal, or for that matter the commissioner, while exercising their enhancement power under section 251 or under section 263, when they will assume jurisdiction, now they will have to assume jurisdictions by initiating it in their order. Then Supreme Court in 379 ITR 521, though I and Somil have tried to ensure that we would not use the judicial decisions in our articles. In fact, during the lockdown period, we have written as many as 10 articles because we have got nothing better to do. So we have ensured that in none of our articles we would take assistance of any judge-made law. But then sometimes we are constant to have it. And this judge-made law, which has been laid down by the Supreme Court, Justice Sikri, as the presiding judge, in the context of section 271 capital E, repayment of loan or deposit. Now even that penalty has got no link with the assessment. Now in this decision, the Supreme Court has said that the penalty has to be initiated during the course of assessment proceeding. I mean, let us take a cue. Unless, I mean, this decision is on the civil appeal. It is not the dismissal of SLP. It is on civil appeal. May not be very speaking order, but then any decision given by the Supreme Court in civil appeal is the law of the land. So when this ratio of 271 capital E can be stressed to section 270 capital A. Now 270 capital A rather stands on all the more better footing, because under section 270A, it is the income with reference to which the penalty has to be imposed. In 271B, it is the repayment of loan or deposit, which had got nothing to do with the quantum of income determined in assessment. And yet Supreme Court said in 379 ITR 521 that penalty has to be initiated, and in case, since in that case the penalty was not initiated in the course of assessment, the Supreme Court said that we will strike it down. So having regard to all these sections and the judicial decision, like in Manjunath's case also 359 ITR 565, the court has said, the Karnataka High Court has said, that there has to be direction as to the initiation of penalty, and that direction has to be in the assessment order. So in sum and substance is that despite all round efforts made by the legislature, so that it should not fall into the trap of those hyper-technical arguments which could come and which revenue always found it difficult to navigate and negotiate. So let us make section 270 capital A foolproof, but then because of the actions, inactions, because of the omissions or commissions of the legislature seems to have scored the self goal, and we are back to the square one. Now all these arguments that the assessing officer ought to have recorded satisfaction, ought to have initiated penalty in the assessment order, all those arguments will come. All those arguments. Now, the next issue. अब मैं मेरे चेयरमैन साहब कहाँ गए? पंकज त्रिवेदी साहब जरा आएंगे.
मैं यही हूँ सर, यही हूँ.
पंकज सर,
हाँ सर.
मेरे पास ऑप्शन ये, या तो मैं अभी मेरे पास बहुत कुछ है बात करने के लिए 270A में. अब मुझे लगता नहीं कि मैं 8 बजे तक 270A के से मैं 271 AA पे जाऊं. तो अब एक तरीका तो ये है कि मैं जल्दी जल्दी करूं वो, बट दैट वुड नॉट, आई वुड नॉट बी डूइंग
जल्दी
जस्टिस।
जल्दी मत, क्योंकि बहुत ही अच्छा वे से रिसीव कर रहे हैं सर, इतने कमेंट्स आ रहे हैं कि एक्सीलेंट
सर फॉर 271 AAD you call me sometime and I will come personally and physically to Hyderabad.
it will be a pleasure sir, it will be a pleasure. So लॉकडाउन को ओपन करने का वो एक बहाना हो जाएगा मेरे लिए प्रे करने के लिए.
So sir, let me proceed the way I am proceeding.
Yes.
And even if it may impinge upon the type on, I mean the time on the second topic.
Yes.
So sir, the issues I am taking, one issue of the recording of satisfaction I have raised. The another issue, I mean that issue was in favor of the taxpayer. But I will be failing in my duty if I do not raise the topic which may be of interest to revenue. Because after all, as you grow, as you evolve, then you tend to look the things in much more dispassionate, objective, fair, judicious, and reasonable manner. I remember during my early days of practice, my partner used to say, my senior partner, Dr. Raj, he used to say, Rakesh, even for an issue of 500 rupees, you would employ and deploy all the ammunitions in your weaponry. But then as you grow, as you evolve, then you tend to be more balanced. So I am going to raise certain issues. The first issue which comes to my mind is as to what was the rationale? What could be the rationale, much less the justification, for the legislature to be so magnanimous so as not to provide for the levy of penalty in respect of the difference between the return income and the processed income under section 143(1)(a). I will give possible answer, but then I will raise certain fundamental questions also. Now, as all of us know that every return is bound to be processed under section 143(1)(a). Now, in 143(1)(a), if you say there are 5 or 6 kinds of prima facie adjustments which are found mentioned: arithmetical errors, some inadmissible claims which are inadmissible on the face of the return itself or information furnished in the return itself, any set of brought forward losses coming from a year for which the return was filed belatedly, disalliances reported by the tax auditors but then could not be incorporated in the return, claiming of deductions under section 10AA, 80IA, 80IB, 80IBA, वगैरह वगैरह. Now, which could be claimed only if you happen to file your return on or before the due date of filing of return, but then you did not file the return and yet you made a claim in your return of income claiming these heavy bulky additions. Now, these would be made prima facie adjustments or additions by the computer, CPC sitting it in Bangalore. Why was such adjustments or additions or the disalliances made by computer by CPC in Bangalore under section 143(1)(a) have not been contemplated by the legislature to be saddled with penalty? The answer which could be there, sir, these are so prima facie that there could not be any motive on the part, and when we could discover it from the return itself, therefore, since there was never any intention or mens rea or culpability on the part of the SSE, therefore, why should an SSE be made to pay a penalty in respect of such adjustment? Similarly, there are orders under section 154. In any 154, in my practice of almost 3.5 decades in various capacities, even as a chartered accountant, I practiced 16 years. 1 year I remained as member of the tribunal, and thereafter for almost 19 years I have been practicing as a lawyer, appearing before the various forums. I have not seen any penalty initiated in an order under section 154 in respect of additions made in the order under section 154, and maybe that may also be for this reason, sir, some error which was apparent from record. Now, if that has come to be disallowed in an order under section 154, that should not call for any penalty. But there cannot be, should not be any blanket proposition, because the nature of error committed by you, now that should, suppose if there is some disalliance, say for example, income tax paid claimed by you in your profit and loss account, and if either the prima facie adjustment is made under section 143(1)(a) or 154 order is passed seeking to rectify this apparent error, even if it is an apparent error. But I would argue on behalf of revenue, when such palpably erroneous prima facie wrong claim are sought to be claimed by you, there should not be a better case in which the penalty should be imposed than this. I remember till 1989, there used to be a provision under section 143(1)(a) for which there was पंकज जी जरा ये जो स्क्रीन अश्विनी जी का इसको जरा छोटा करें, जरा मुझे दिक्कत हो रही, पूरे उस पे आ रहा है स्क्रीन पे ये
हाँ
हाँ हाँ ठीक है, इसको आप ये बीच वाले को जो बड़ा वाला है इसको ऑफ, मतलब इसको वो कर रहे हैं।
आपके पास एक स्पीकर व्यू बोल के रहता है, ऊपर देखिए स्पीकर व्यू पे क्लिक कर लीजिए आप, सब में ऊपर।
मेरे में नहीं है, हो सकता है यहाँ गैलरी व्यू तो आ रहा है।
हाँ वही उसी में जाके वही स्पीकर व्यू आप क्लिक कर लीजिए।
अच्छा अच्छा अच्छा, हाँ स्पीकर व्यू, हाँ ठीक है ठीक है, ओके।
अभी आप कंफर्टेबल है सर?
हाँ यस 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 यस। सो एट दैट टाइम देयर यूज्ड टू बी a section 143 subsection 1 capital A which used to provide 20% additional tax in respect of the taxes leviable on such prima facie adjustment, and whenever such additional tax used to be paid, then explanation 6 to section 271(1)(c) was there to provide that in respect of such prima facie adjustments now would not be levied, as insofar as the revenue is concerned we have taken our own share out of this flesh in the form of additional tax. But now that kind of disincentive, disability, charging of additional tax has not been there in respect of prima facie adjustment. Therefore the question comes, why? So if the legislature has chosen to be magnanimous to the advantage of the taxpayers, let it be. Now another instance, now if a person who has never filed the return of income now files his return for the first time in response to notice under section 148, initially this situation was not there in 278, it was added subsequently but with a retrospective effect. So if a person who has never filed the return files the return for the first time in response to notice under section 148, then in that situation the penalty will be calculated and computed with reference to the tax on assessed income and the basic exemption limit in case that person is individual or HUF, but if he's a firm or a company, then the entire assessed income tax on the assessed income that would constitute the underreported income. I mean the difference between the assessed income and the zero, that would call underreported income. But imagine a situation that a person who has never been assessed, now on one fine morning or one fine evening or afternoon is caught by the search team under section 132, the search is conducted. Now having been cornered, he will be issued notice under section 153(a) comes and then files the return declaring substantial amount of income. Now this situation in respect of this income which he discloses in his return under 153(a), penalty under section 270(a) is not envisaged, surprisingly, to my amazement and to my anguish, that defiance is at premium. A person who has been so recalcitrant, that who has not even observed his primary obligations to file return of income, extreme action in form of such has taken place, he is cornered and then he is coming out bearing his chest by declaring income, and such declared income under such circumstances, if it is not visited with penalty under section 270(a), then I think penalty provision should be consigned into the dustbin of history. The next situation, we have seen that situation that if the income assessed or reassessed has the effect of reducing the loss or converting such loss into income. But what about if I have got brought forward losses coming from earlier years, and because of the brought forward losses being carried forward in this year, my return income becomes nil, and I carry forward the balance amount of brought forward losses as the carried forward losses. Any addition made in the assessment order, and despite such addition, that addition is also subsumed in the brought forward losses. Suppose I filed a return, suppose I have got brought forward losses of 60 lakhs. Let us be very simple in our example. I have got current year's income of 50 lakhs. So I file return of nil, carrying forward 10 lakhs rupees as the carried forward losses. Now addition of rupees 7 lakhs is made. Now despite this addition of 7 lakhs of rupees, my income of the current year would become 57 lakhs, but which is less than the brought forward loss of 60 lakhs. Therefore, my assessed income would still be nil. Though that is a different matter, my carried forward losses would be reduced by 7 lakhs of rupees, and as against the 10 lakhs of rupees, the losses would become 3 lakhs. But so far as the income assessed in this year is concerned, it is nil. Income returned and processed in this year was nil. There is no difference. There was no underreported income, and this situation has not been envisaged under section 270 capital A. What would happen in respect of the larger credit which you have claimed in the future years? Now, but if you can revise the return of the future years, though it will be very difficult given the time limit under section 139(5) now, that because it has to be revised on or before the close of the assessment year. What would happen there? That is a different matter. But so far as this assessment year is concerned, I mean, there will not be any penalty. So if you file any income in the return or in the revised return, obviously, even that revised return, which is filed in time, would also be processed. So let us assume that the revised return was filed in time, it was processed also. Therefore, any additional income which you declare from the original return and in the revised return. Now, with reference to that also, there will not be any penalty, because when the assessment would be made, the difference will be seen, income assessed and income processed, and that processed with reference to the returned income which has been revised return which has been filed in time. But there are two things in respect of revised return which has to be borne in mind. First is it has to be filed in time. So I am assuming that additional income which you have offered in the return of income or in the revised return of income, that has been filed in time. So that hurdle now has been crossed by you. But another hurdle is also there, which many of us, again, even at the cost of repetition and emphasis, I would say, I need your special attention. The thing which I am going to discuss may not be considered by us from that standpoint or from that perspective. And that perspective is, it is not any or every income which can be offered in the revised return. All that which can be offered as additional income in the revised return is income on account of any omission or error or wrong statement discovered. So the word discovered is very important. Discovery presupposes an element of surprise. You were not knowing, you stumbled upon, you found, oh, this was an error, this is an omission, this is a wrong statement which came to be made. Now I have discovered it now, therefore I am revising it. It is not any income, because many times we tend to understand as if revision is our birthright. Yes, it is right, but then only when the conditions obtaining for revisions are available. And one of the condition obtaining for revision of a return is that it can be revised either on account of error, omission, or wrong statement. But all these things must be as a result of the discovery, not if you had already known it. So if there was some penny stock income, which I initially claimed as exempt under section 10, subsection 38, or some accommodation entries, or for that matter, it can be any other income, because all these additions again will be made under section 100, section 69, and then 115 BBC 2. But there can be any other income which you withheld in the original return, and later on with the change of heart on one fine morning, you say, okay, now let me disclose it in the revised return by filing it in time. But then if the assessing officer is smart enough, then he can say your revision of return, though done by you in time, as visualized under section 139(5), cannot be said to be a validly revised return because of the fact that you are not fulfilling the obligations of discovery, and therefore I reject this return. And then if he takes this quasi judicious decision rejecting your such kind of revised return, revised in such circumstances, then probably his action may be justified, may be upheld by the higher appellate authority. And in that situation, you fall back like the game of snake and ladder. You fall back to your original return, and the difference of income assessed and the original income shown by you in your return, now that difference would constitute additional income, meaning thereby that additional income which you offered in the revised return, since your revised return having been rejected, therefore now would not be considered. Now there are two subsections, both subsection 4 and subsection 5 of section 270 capital A. And you would kindly recollect that we had got explanation 2 to section 271(1)(c) also, which are identically worded. That if the source of any receipt, deposit, or investment in this year for which the assessment is on is sought to be explained with the help of the intangible additions made in earlier years, in respect of which the penalty was not levied, then such intangible additions made in earlier years and which covers the amount of receipt, investment, or deposit in this year would constitute underreported income, but not of this year. They would go to the respective years when intangible additions were made in LIFO method, last in first out method. So suppose if an assessment of assessment year 2021, suppose, because the 2021 has not, become time and pandemic also, it's not possible for the purpose of, suppose an assessment for assessment 10 at 2021 is taking place. There is an addition of rupees 25 lakhs on account of investment made by you. When assessing officer asks, okay, explain what is the source of this investment 25 lakhs. Now you say, sir, 15 lakhs related to assessment year 2017-18 in respect of the gross profit addition made in that year, and 10 lakhs of rupees for assessment year 2014-15 when some other intangible addition was made, some ad hoc addition was made, and in both these years the penalty was not levied. Penalty was not imposed in 14-15 under 271(1)(c) and in 17-18 under section 270 capital A. Now, as per the decision of Supreme Court in Anantveer Singhaiya's, this explanation that the current year investment having come from the past intangible additions, now it is liable to be accepted. So no addition will be made in this year, because we have been able to explain the source with reference to the additions made in the past. But subsection 4 and subsection 5 of section 270 capital A and erstwhile explanation 2 to section 271(1)(c), they say that such underreported income at that time is concealed income. Such underreported income would be treated as underreported income for the respective year. So in assessment year 17-18, 15 lakhs, that will be underreported income, penalty will be initiated and imposed. Because penalty was not imposed at that time, because this was an intangible addition. These were the ad hoc additions. These were the additions at that time. suppose ad hoc GP addition. And assessment year 14-15 at that time 270 was not there, 271(1)(c) was there. So 271(1)(c) for assessment year 14-15. Though in normal circumstances it has become barred by limitation as per the language of section 275, but because of subsection 1 capital A given in section 271, the period of limitation in respect of that intangible addition revives. But as I said, almost in the middle of my discussion, there is no corresponding subsection or there is no corresponding provision on the lines of subsection 1 capital A or section 271 in section 270 capital A. And therefore, in certain situations, there may be serious issue that the year for which now you want to impose penalty under section 270A subsection 4 and 5, now this has become barred by limitation. I remember my very good friend Mr. Murli had asked one question, whether 27011C has become irrelevant. No. First of all, it can be levied up to assessment in 1617. And even after the advent or introduction of new provision 270 capital A, in certain situations, as the one I discussed just now, penalty under section 27011C in respect of the earlier years, 1617 and earlier years, now can be initiated. The ghost is not yet, the ghost is alive of 27011C even during the course of the present day assessment proceedings. So friends, I think it is almost 8 and 271 AAD, and I'll speak I mean not more than 1 hour, but I mean not less than 1 hour, because that will not, if I try to reduce in 10-15 minutes, probably I may not be doing justice. So let us keep it for some other time, because there may be questions also on section 270A. And as Pankaj ji said that there are several messages that I have spoken very well, so I'd like to watch and witness them also. So
And thanks to you, we are also getting credit, sir. So they say thank you Hyderabad branch. So it's only thanks to you I'm getting some thanks.
I have learned from Hyderabad, and if I am able to share whatever little I have learned with Hyderabad, it is an honor for me.
Yes, sir. Sir, before, in fact, what we'll do is, I'll just we are having about 12 question and answers today, but I'd also like to make one announcement before we just decide for a further course of action. Ashwini sir has just left because he has got something important, and he just wanted to tell each one of you that tomorrow, after Sri Amit Khemka ji is speaking, he'll be speaking for about an hour or so. And after he speaks, then the most important thing is, I've never seen such kind-heartedness of such excellent speakers. All 4 speakers we had till now, all are going to come back, and it's a first time in my life they say open hai. Chalo tumhara jo karte karo. Income tax, international taxation, black money, benami law, prosecution, penalty. जिस पे क्वेश्चन पूछना है, you ask, we will answer. See, that is where the people with knowledge only can speak about. And after hearing them, and after hearing some comments from Amit sir yesterday, I am sure it will be an excellent thing. Only one small thing. Tomorrow, I will start the session at 5:30 p.m. itself. So if you have any questions, you can post them there so that the speakers can take it up. I'll give half an hour. And yesterday some questions were there. That questions I'll forward it to speaker. And today also, sir, I leave it to you. It's almost 8 o'clock. There are about 12 questions. So do you want to cover it in tomorrow's question answer session?
Sir, I just wanted to make very humble request, subject to I mean your mandate and Dayanivas sir. Though I was to come tomorrow, but you see, now I am in a very difficult situation. My wife is member income tax appellate tribunal posted in Chandigarh. She comes on Friday. I am seeing that she is walking in the garden, and she is and tomorrow if I have to sit for 2 hours and 3 hours, so probably that may not be conducive to my happy married life.
Members के against चले जाएंगे sir decisions.
So
राकेश सर,
yes sir.
मैडम को हम लोग रिक्वेस्ट कर देंगे और कर लेंगे,
उनको भी बुला लेंगे सर.
मैडम को भी बुला लेंगे सर, नो प्रॉब्लम.
Sir, Pankaj sir, I am what should I say, since I left the tribunal I could not do justice because of my family, because my children were very young. They used to miss me. Therefore, I am compensating that, and my wife has taken the mental right from 2015, will remain there till 2030. So the thing which I could not do now, so that continuity is on. That is what I wanted to say.
Nice.
So, Pankaj ji, tomorrow Dr. Rajkumar Agarwal will also be there.
Yeah, Dr. Rajkumar Agarwal will also be there. Na?
He is my partner.
Yes.
I and Raj have authored the books on real estate and search and seizure.
I'll also take it as your consent to invite Mr. Somil Agarwal also.
Oh yes, yes.
So
yes.
that it will
Yes, yes.
at least compensate.
And I have requested Somil to send the article, but then I saw somebody has already taken out from
Yeah.
online and then has flashed it.
Good, sir. So, sir, would you like to answer any?
Yes. I will answer today. If I am not in a position to answer because of my incompetence, then I will read and then I will come back
सर
tomorrow.
अभी
then.
मजाक
अरे
राकेश जी
सर,
राकेश जी अभी तो
आप मजाक के मोड में हैं सर. Sir,
So, पढ़ें सर.
yeah.
Yes.
Sir, I'll just start with the question of Bharti Agarwal, who says that whether section 270A subsection 1 mandates that penalty under the section can be passed only during the course of proceedings and not after the order is passed. In other words, whether there is a departure from 271(1)(c) between initiation during assessment vis-a-vis under 270A, which states direct during assessments.
Very good question. In fact, under section 271(1)(c), the phraseology though was there during the course of the proceedings, but during the course of proceedings, those authorities were to satisfy themselves as to the existence of either or both of the charges which are there under section 271(1)(c). सर उसी को ऊपर करें सर, ये ऊपर.
अच्छा, वापस क्या मैं
मेरे सामने ही रहेगा ना वो भारत
ओके सर, एक सेकंड सर,
सर मेरे सामने लाए उसे सर.
एक सेकंड, मैंने क्वेश्चन को आंसर्ड में डाल दिया था ताकि देख सके. जस्ट एक बार आंसर्ड में देखिए ना सर.
ओके आंसर 1.
Answered.
Yes. So during the course of the proceeding, though phrase is there, and during the course of the proceeding, these authorities may direct that any person who is under, that is why the initiation has to be during the course of the assessment proceeding is coming out from this fact also, though the direction to pay penalty would be post facto assessment. But it's a good question, and it seems to be a drafting lapse, because when you pick up certain things, omit certain things, then such kind of legislative lapses are bound to happen. So next question. Yes.
Yeah, I'll just go to the next question, sir.
Yes.
Whether in assessment order, the AO has to specify underreporting or misreporting of income?
Yes. So regarding the underreporting, of course, when there is a difference between the assessed income and the processed income, yes, he can say. But then under section 270A subsection 9, now there has to be underreporting in consequence to misreporting, and section 271AA, the immunity, which is there, which can be claimed by a person if it is not as a result of misreporting. So that satisfaction or initiation must come in the assessment order with a that is why when I said that the department has scored the self goal and the condition of the recording satisfaction can still be traced. So assessing officer will have to record whether it is a case of underreporting simpliciter or underreporting as a result of misreporting. He need not to specify that under which clauses of misreporting this would fall. It would be enough in case he says underreporting in consequence to misreporting. Yes, next.
Thank you. The question is from Anand Sharma. The SSC avails / seeks the benefit of immunity under section 270A for current year. Department grants it after following due procedure. However, department initiates penalty on the same issue in case for earlier years. Can the department take the adverse view in case of earlier years, or SSC has right to contest for seeking immunity for earlier years as well?
No, because the immunity can be availed under section 271 AA within a particular time frame. Suppose if the time frame has gone, and since these provisions are conferring immunity, they have to be constituted very strictly. But this immunity in this year claimed by you would not be pitted against you in respect of the similar additions or disalliances made in the earlier year. And if you remember, in case of the clarifications issued by the government in case of Vivad Se Vishwas, an identical question was put and the board has said, no, we will not take it as a concession for the purpose of seeing its relevance on the levy of penalty. So it will not have any bearing on the levy of penalty.
Yes. In fact, he has continued using the same thing, saying that can the SSC use the new government scheme Vivad Se Vishwas to clear the dues?
Yes. That is how the law is evolved.
Okay. Sir, the next question is from Nitin Furia. One is specific direction, including specific subclause, is required to be mentioned in the assessment order.
Sir, according to me, specific clause may not be mentioned because if you remember, I said that all the clauses submerge into the first clause, misrepresentation or suppression of facts. But then all these clauses, even misrepresentation and suppression, they also fall into underreported income in consequence to misreporting of income. Or for that matter, even the misreporting also falls in underreported income. But because SSC has to avail the immunity, and therefore, in order to give or effectuate the provision of section 270 capital AA, now specification at least to this extent that this is misreporting of income, that should come in the assessment order. Precise clause may or may not be there.
Yes, sir. So I'm going to next question from Malladi Venkat Ramana Prasad. Is there any provision of appeal against the penalty levied for the SSC to challenge?
What do you, I mean, provision of appeal against the penalty levied, of course.
Yeah, along the against the penalty levied.
246A, this first appeal is there.
Yeah, I think the next one is your book only. And then I'll go to question from Varaprasad. I am getting disallowances notice for employee contributions to PF under 36, even if paid before the filing of ITR. What is the remedy?
Okay, if you strictly read the language of section 2 subsection 24 clause 10 read with section 36 subsection y subsection 1 clause 5a read with its explanation, employees contributions, strictly speaking, I am on the literal law, strictly speaking, the employees contributions would become income and the deductions will be allowed to you under section 36 when you happen to pay it on or before the due date under the respective legislations. In fact, payment up to the due date of filing of return, if you read carefully, is there under section 43B in respect of the employer's contribution. But a good number of judicial decisions had come, and to few of which even I have also been party in LOM execution, I mean, which was spoken by Mr. I mean, my friend who is spoken.
Machara.
The LOM execution Supreme Court decision. I was party to the decision, and in that case also employees contributions were there, but then that aspect has not come very nicely by the judges in their order. But in other decision of AMIL, AIIMIL Limited of the Delhi High Court, the employees contributions were there, and the argument, I remember Justice Sikri as he then was in the High Court, I made out a case before him or before the bench for that matter, that employees, the moment you deduct from employees, then it becomes the employer's liability, and therefore section 43B, I mean, should govern it. And even on that logic, if it has been paid on or before the due date of filing of return, now it should be allowed, and it was allowed. But again, now this thing has not come very nicely in that order. Now, what is the problem? The CPCs in Bangalore, Karnataka High Court has taken a view, and CPC being in the jurisdiction of Karnataka High Court does not have any option but to follow that. In Andhra Pradesh High Court, I do not know whether what is the interpretation. So if High Court is in your favor, then of course now your jurisdictional High Court is in your favor. But even if it is not in your favor, then the view favorable to the taxpayer in such a situation when there are more than one view is available, now that has to be followed. So you'll have to go in for appeal, and then you'll have to get it.
Yeah.
Yes.
So, continuing, not the question here, in fact, continuing the same thing, what the CPC is doing is they are raising demands, giving an imaginary figure. So for example, the Form 16 says 10 lakhs, the 26A is also says 10 lakhs, the SSC has also filed the return giving 10 lakhs. Now CPC sends 143(1)A saying, no, your income is 14 lakhs. How many grievances raised, how many rectification filed, saying that please you tell where from you got 14 lakhs will all be rejected. And what is to be done, we are just unable to understand, sir. In such,
Sir, the only recourse which is available to you apart from administrative pursuit is related to file appeal. Now, if I'm going on the side of the road, if some vehicle comes, hits me, then I'll have to get myself cured, or I'll have to take action against him later on. So, but then if he has hit me, then he has hit me. So if the CPC has hit you, then hit you. So you'll have to take recourse to the legal remedies. That's all.
yeah, because more than hundreds of such cases have come, sir, where they have just come up with some imaginary figures. So now all the litigations
Sir,
will come.
Sir, that is how our profession.
So, yeah, thank you. It's a brighter side of the story. Yeah. Sir, I'll just take the question from Surya. Can an assessment be opened on the basis of fresh evidence of concealment of income after the completion of reassessment period, and whether interest penalty will also be levied?
Of course, under section 147, if an assessing officer has reason to believe that income chargeable to tax has escaped assessment, and even if post facto some new additional evidence comes which suggests that the income has escaped assessment, why can he not reassess it? I mean, section 147 is meant for it. And once, the reassessment is made, then of course interest, penalty, and everything will follow.
Ashok Sharma, at 7:55 p.m. I hope I'll just make whether exclusions are exhaustive or there can be any other exclusion.
Sir, so far as exclusion, you are talking of subsection 6. If you take even the first exclusion, that covers like the elephant's कहते हैं ना हाथी का पांव. I mean, that is so omnibus that covers everything. But legislature, like similarly under subsection 9, even misrepresentation or suppression, that covers everything. But the legislature has tried to, bring exhaustive clauses, but then these are the exhaustive clauses. So in any case, if sixth clause is in your mind, any sixth instance is in your mind, that will be covered under clause A of subsection 6.
Sir, if the SSC has not filed return and has paid full tax, that is the case of foreign company whose TDS has been deducted and the return has not been filed, whether penalty under 270A shall be leviable.
Yes, because here the issue is about the tax on the income assessed and the tax on the income returned or processed. So in such a situation, even if you may have paid tax, you can claim equity, but then the equity and tax are strangers. They do not go hand in hand. They are like the warring husband and wife. They do not sleep together. And therefore, that aspect of equity cannot be claimed by you. And if you fall within the literal constructions of the law that you have to pay penalty, then you have to pay penalty.
Pankaj bhai.
Yeah.
Pankaj bhai.
Yes,
You
sir.
you missed the message by Rakesh ji that madam is walking in the garden.
Yeah, I'm sorry.
Your greed is actually making you.
In fact, I got so involved in the question answers or getting
I know.
My
without
apologies, sir.
But without answers, then this process. मैं एक तो 271 double AD नहीं बोल पाया, फिर ये भी नहीं करूँगा तो I will be doing injustice.
नहीं सर, हम एक काम करेंगे तो 271 डबल एडी का तो पूरे क्वेश्चंस होंगे. मैं ये क्वेश्चंस आपको अलग से मेल कर देता हूँ, या कल अगर सोमिल से नहीं हो सका.
नहीं सोमिल would explain better than me.
Thank you, sir. Sir, so what I'll do is, Deva, you want to say something before I just close?
No, sir. सर इसमें आप ये सारा मुझे आप मेल कर दीजिए प्लीज.
मैं मेल कर देता हूँ सर. सर, thank you very much. One is my gratitude, my thank you very, very much to you, and I'll be failing in my duty if I don't thank Somil Agarwal also, who has done so much on this section. I really thank Amit Kemkar sir for being with us yesterday and today. And I'd like to remind all the participants that tomorrow Amit Khemka ji would be speaking on handling of offences and prosecution under FEMA, TMLA, Income Tax, Benami Law, Black Money Act, and Companies Act. And most importantly, all of them would be there for the panel discussions tomorrow. So please remember, we, the attendees and the organizers, will start the seminar webinar at 5:30 p.m. only for your questions, and the speakers will join 10 minutes to 6, and we will start it sharp 6 o'clock. So thank you very much. Thank you very, very much, Rakesh ji. My apologies to your wife. और हम चाहेंगे कि एक दिन आप
That is on the
दोनों
lighter side. That is on the lighter side.
I know sir. एक दिन हम
नहीं,
चाहेंगे कि आप दोनों
Thank you,
मिलके
Rakesh ji. Thank you, Amit.
एड्रेस कीजिए.
ठीक है.
Thank
पंकज
you
भाई,
very much, Amit sir, and thank you very much all the attendees who are there. Thank you very much, sir.
पंकज भाई,
Yes, sir.
जस्ट राकेश जी एक ही बात मैं बोलूं और अमित जी आपको अभी एक बात बोलूं. जब आप सेशन, व्हेन यू आर टेकिंग द सेशन, पंकज भाई एक्सक्लूसिवली कॉल्ड मी एंड ही सेड, भाई ये आप मतलब इतनी बड़ी तोपों को कहाँ से लेके आए? तो मैं बोला दिल्ली में बस्ती है तोपें.
वो तो एकदम सर.
So we are really,
We are students, sir.
नहीं सर, बहुत अच्छा.
नहीं
बस
सर,
इतना ही प्रॉब्लम है
you are
सर,
kind
अभी
enough, राजा.
हैदराबाद छोड़ेगा नहीं आप लोगों को. हर टॉपिक में पहले आप लोगों के पास ही भाग के आएंगे.
अरे सर, so nice of you, sir. So nice. Thank you, sir.
Thank you,
सर
sir.
राकेश जी अभी
Thank you.
एक रिक्वेस्ट है मेरी हैदराबाद ब्रांच के तरफ से,
Yes, sir. Yes, sir.
क्योंकि मैडम भी अभी आपके पास आ गई है.
हाँ, हाँ.
Madam also has come. If you both can join for some time tomorrow,
सर
it
वो
will be a very big
आप
opportunity.
सर उनका टेलीफोन नंबर मैं दे देता हूँ, आप एक बार उनसे बात कर लीजिएगा. तो मेरा कहना और उनका आपका कहना, आई मीन देयर इज अ लॉट ऑफ डिफरेंस. वो घर की मुर्गी दाल बराबर होती है ना.
नहीं
चाहे 1963 में पैदा हो, चाहे 1985 में गया, सिचुएशन तो वही है. युग युग से बीवी के सामने कोई कुछ नहीं बोल सकते, तो हम सब मान लेंगे ये चीज. थैंक यू.
It is a fantastic session, Rakesh ji. Thank you very
बहुत
much.
अच्छा था सर.
And I'm really delighted you have reached to Hyderabad with us, and I'm really thankful to Ashwini ji and to introduce all of you to us, and particularly this entire thing of learning session, the kind of compliments we have been getting. I have received a couple of messages. It's amazing. Now also you are receiving fantastic session karke. Amit ji, thank you very much. From my side also, learned people like you actually makes me to come back on the screen. Honestly, I would not like to be, but it is my duty that I come and share my thanks from my side on behalf of Hyderabad branch, Hyderabad members, and there are multiple locations people have joined us today and yesterday also. I am thankful for them also. So thank you, Pankaj bhai.
Thank you.
And let us catch up tomorrow.
Thank you. Yeah, 5:30 p.m. Thank you.